In this video, we're going to look at forecasts for 2024 for the S&P 500. We're going to delve into what it means to crypto. Specifically, we're going to look at sentiment, the latest 2024 Wall Street estimates, potential global market impacts, risk asset correlation, Bitcoin, crypto and the ALTS, why Wall Street estimates differ, and historical patterns for the S&P 500, Nasdaq and global markets. Then we're going to tie everything together. I want to help you to outsmart Wall Street, to get ahead of the Wall Street analysts, to see the structure where the S&P 500 can actually go. And I'll share the SCs, the structural support and structural resistance levels for the S&P 500. Let's run the numbers. Welcome back, everybody, to the Daily Show. If you like this kind of content, please like and subscribe. Let's have a look at the sentiment. You have to admit, it's pretty positive. According to Barron, stocks beat the odds this year. Why they can do it again in 2024. Goldman Sachs sees the S&P 500 hitting 5,100 in 2024, boosting its forecast. We're getting pretty bullish readings right across the board as far as investor sentiment goes. Things are looking pretty fine for the crypto market as well. Van Eck predicts an inflow of $2.4 billion when a US spot Bitcoin ETF is approved. That is likely to be literally the first week or two inside January. It's very important, even if you're only in crypto, to understand the estimates of the S&P 500. Let's look into the latest 2024 estimates from Wall Street. I wanted to give you a bit of an overall understanding as to where things are going. Overall estimation predicts that the S&P 500 will continue to rise. When it comes to 2024, different analysts have different outlooks. For example, expert analyst Yardeni expects 5,400 for the end of year S&P 500. Goldman Sachs, Deutsche Bank and BMO 5,100. Bank of America, RBC and Federated Hermes 5,000. NDR 4,900. Morgan Stanley 4,500. And JP Morgan 4,200. Look at this, all the way down here. BCA Research is predicting anywhere between 3,300 and 3,700. You can see it's a pretty wide disparity. Bank of America expects a closeout of 5,000 for the S&P 500 at the end of 2024. What they're predicting is that the market will basically just flatline, consolidate all through next year. This means it's a trading year. A lot of people think that the S&P 500 is disconnected to, for example, the DAX, the CAC 40, the FTSE, the ASX and other global markets. This couldn't be further from the truth, and I'm going to prove it to you. We have a rule inside the Masterclass, Rule 217. No stock market can escape the US's gravity. Delving into LV19, global markets and Fed recessions, you can see the Nasdaq, the S&P 500, the Dow, the Russell, they're all going parabolic, and the majority of the world's stock markets are moving with it. As well, keep your eye on Bitcoin. You'll see something fascinating as we go through. The basic story, if the S&P 500 starts to stall out, we would expect all the major indices, the Nasdaq, the Dow, the Russell, to do so. And we would expect the same across the world. Interdependency and intercorrelation are very important to understand. So let's have a look at Bitcoin and crypto and how they're related to the S&P 500. From the Masterclass, Rule 225, Bitcoin cannot escape the stock market's gravity. This is a really important rule, and again, I'm going to prove it out to you. A lot of people will say the crypto has decorrelated from the main markets, the stock market. This is false, and it always will be. What we can see here is the directional correlation between Bitcoin and the S&P 500. You can see they're pretty much very, very well aligned, and this is the case. What happens when the S&P 500 tanks, such as what happened in C19? Everything tanks. We saw retracements across all the global markets. For example, I can just show you right here from LV19. You can see how all the global markets will pull down at the same time. This is why it's critical to understand where the S&P 500 is going. That is why it's a tier 1 chart. What about the crypto alts? Can they escape? As you probably already guessed, no they can't. Rule 45 tells us the reason no alt can escape Bitcoin's gravity. Unfortunately, a lot of people fall into the I only trade trap. They don't look at the main markets. They don't look at Bitcoin if they're not putting money into it. This is a huge mistake, and it's a common one when people are just starting to learn. Let's go a little bit deeper. The alts move in directional correlation with Bitcoin. This is total crypto market cap, this blue line. The gold line is Bitcoin, and of course that's the S&P 500. You can see that the alts and Bitcoin always align. This is not by mistake. If Bitcoin is having a party, all your alts are invited and they will party harder. If Bitcoin has a hangover and is passed out and draped over the couch, you can be assured all the alts are underneath the house. Now the key is, why do those estimates differ so much on the S&P 500? You can see there's a wide variation between all of the different estimates. There are two things to really be on the lookout for. One is RIP, two is SBA. What the heck is RIP? It's recent indicative price analysis. What is SBA? Well, that little fairy may give you a bit of a comprehension. It is story-based analysis. A lot of the stories come down to how people look individually at economic data. Some people are very, very pessimistic, and they always will be. There are some YouTube channels that have been calling for the end of the world since they were started many, many years ago. Some other YouTube channels and social media influencers are highly positive. Our focus in this community is not to be positive and not to be negative, but just let price reality guide our decision-making process. Looking at the charts from LV20 from inside the Masterclass, if we look at the effective federal funds rate, which is the base interest rate inside the US economy, we can see it's just come up so hard and so fast. This has placed so much pressure on the banking system, it's starting to curl over now as inflation gets under control. We can see the same thing is happening with the US interest rate. The spike in the 30-year fixed-rate mortgage on average has been devastating to so many people. When we look at the unemployment rate, it bottomed out and it's starting to tick up. Consumer sentiment has been on a very big decline, but it's starting to recover. Initial claims were increasing, but they've started to decrease, showing the sign of a strong labour market. But when we look at personal savings, as a percentage, it's really low. It did go up when the pandemic had a spending spree. The printers went brr, but since then, it's pretty much all but vanished. The reason why estimates differ is different analysts have a different concept on if we're going to get a hard landing, a soft landing, or simply a continuation. One thing to bear in mind, with the AI revolution occurring, that's a complete change. We're going to see economic growth like we've never experienced before. Let's turn now to historical patterns in the S&P 500, the Nasdaq, and global markets. These patterns are completely eye-opening. They'll give you an incredible edge. You may have heard a lot about the Santa Claus rally. That's the last 5 trading days in December and the first 2 trading days in January. The theory works like this. If you buy on the 3rd Friday of December before options expiration and you sell on the close of the 3rd trading day of January, you're going to get, on average, much better per trade returns than you would otherwise get. This occurs about 75% of the time. And the exact days really depend on the calendar days for December of that year. Sometimes we'll see December retrace only to see January really go for it. When looking at the best and worst months over the last 20 years and over the last 10 years for the S&P 500, we can see November and December aren't bad at all, but the first start of the year is typically weak, weaker than the other months. Since 1972, the monthly gain frequencies of all years for December have looked really good. And then you can see it drops quite a lot in January and February. For odd years, such as 2023, which has been quite odd, you can see there's a bit of a ramp up in December, and also January is not bad, but there's a problem. When we come to January, we're in 2024. That's an even numbered year. How does it go for even numbered years? That's pesky. Historically, we'd be pointing towards a bit of a retracement in January and February. Retracements are no issue if you're trading. It really depends on how much data you look at. When you look at January since 1950, and that's quite a few years ago, you can see January is not too bad. When we look at the Dow, the average monthly gains are looking pretty good from 1950 to the present day, and January's not looking too bad either. What about the Nasdaq 100 best and worst months over the past 20 years? We can see the best months are in July and in November. December's not too bad, but January is better. What about the last 10 years for the Nasdaq 100? We can see December, it's not too bad, but not too good. It's not as bad as September, which is good. But when we come into January, it's about the same. What about global indices such as the DAX, the Euro Stoxx 50, the FTSE and the Nikkei? When we look at those compared to the US indices, we can see December is generally pretty good across the board, and January and February are weaker. This can give you some insights into what could happen at the start of next year. And when we're looking at average returns, we can see the Euro Stoxx 50 and the FTSE and the Nikkei. They're all pretty lackluster compared to what they do in December in terms of what they're doing in January, and this is data over the past 50 years. It's time to go beyond the forecasts. The key is to ditch SBA and RIP. SBA, story-based analysis, and RIP, recent indicative price. Rule 238 guides us, have no story, just pay attention to what price is actually doing. A lot of people could say, it's going up and up and up, but if price is going down and down and down, clearly they're not correct. How do we know where price is going? We look at CTKS structure first, which is Rule 240. It's important to understand the price is always moving between structural levels. It will come down to structural support, go up to structural resistance, back again, back again, back again, back again. What you will find as you get deeper and deeper into an understanding of CTKS structure, price literally just moves structural level to structural level. What are the structural levels for 2024 for these areas? CTKS structure, which is the world's most powerful smart money buy and sell level detection system, has at its core objective dynamic market structure, or ODMS. ODMS means that we need to wait for the year to tick over before we can do the estimates on 2024. But we still have a fairly reasonable idea of what's going to occur within the next, or within December. What we can see right now is we're coming up into structural resistance. This means that probabilistically, if we get above this particular structural resistance zone, and we'll get to that in a minute where that is, there's much less structural overhead resistance than what a lot of people actually understand. And if we don't maintain this, we've got a structural support level below price. This is never drawn from recent indicative price. These structural bands, called SZs, are formed from a standards-based methodology. What we can also see, there's a lot of structure inside the market where price, even if it calms down, it will get caught in these areas. And you can see there's some very heavy areas. This particular analysis is just the up and the down percentages on those Wall Street estimates. But what we're doing is we're adding context into it so that you can understand where structural support and structural resistance levels are. If you'd like to know more about Level 1 Standard Certification and Level 2 Standard Certification, they're the two things that you'll need to learn to draw those areas up. There's some information at ctksmethod.org. One of the most important things we can do right now is to ask where structure says that the S&P 500 can go right now. Just zooming in on these zones, we can see that when this picture was recorded, the S&P 500 was 47.68, just nearly coming into a structural resistance zone, but leaving behind a structural support zone. You can see also, if we start to lose this around 4700 mark, there's a negative fresh air gap here. We could drop down to 4590 very quickly. This is why it's critical to understand where the structure actually exists inside the market. To get ahead of Wall Street analysts, we're going to turn on some indicators. When we pop on the indicator for the S&P 500, we can more clearly see where the structural resistance levels are. We can see that we're coming up to quite heavy structural resistance, but we've left a concentration of now structural support. We're entering that fresh air gap and nearly filling it. We would expect the sellers to come in here and seek to push price down. What you saw recently, there was a huge amount of structural support inside the market. That meant the price could move up quickly because there was very little structural resistance inside the market. But when that structure hit, the really heavy structure, it stopped the S&P 500 on the spot, and it needed time to recover. We're seeing a lot of flow-through positive momentum. But one thing to bear in mind, this overhead structural resistance is really tough. It's going to be tough to get through. The indicator that you saw is forwards looking, not backwards looking. Most indicators such as EMAs and RSIs are all backward looking. CTKS method indicators are forwards looking. We look at this and see, price is getting over this structural resistance level. It has very light. There's a positive fresh air gap between these two areas. It could move very, very quickly, and it did so. So much consolidation and then such an explosion. These explosions mean that there's very little structural resistance when the price is going up. Beware, they can work on the downside too. If we lose this 47.20 mark and we start to come down, we could come down very quickly. I always refer to these areas, these SCs, as ceilings or safety nets. If you have a lot of safety nets below you and they're highly concentrated, that means the price will hit them and bounce. But if you have very few, it can pass through them without even looking backwards. This is the structural indicator for the S&P 500. You can get structural indicators on all of the Tier 1, Tier 2, and Tier 3 charts, and you'll need them to understand where the safety nets and where the ceilings are. But if you know how to do Level 1 and Level 2 standard certification, as we enter the end of the year, we can see that we don't have that much in terms of structural resistance above us. And we do have a bit of structural support, but it's fairly light. It's fairly light in either direction. That means this particular structural resistance is absolutely critical to overcome. If we can't get over 48.20, that is bad. That is bad for every single market globally, as well as crypto. Getting your timing right is really important, and when you use these forward indicators and your knowledge of the CTKS method, you can get your timing done on any chart that you look at. And Rule 241 is a powerful one. Timing done right is always early. The S&P 500 is highly reliant on economic data. It's highly reliant on Forex yields, bonds, and these areas impact commodities as well. When we look at the S&P 500, it's a flow through of a lot of different things, and crypto is connected to that. Always seek to understand price reality and the structural support and resistance levels when you mark up all of price data, not just recent price. And if you come across to ctksmethod.org, you can get a free printable template of the CTKS timing cheat sheet. This one will be out very soon. It's nearing the end of its beta development. There is an earlier version there. What would support the S&P 500 moving up is to get over this structural resistance, to move forward positively and overcome that. That will happen if the DXY continues to decrease and the yields, the 2-year and the 10-year, keep on going negative. We would also want to see a big improvement in junk bonds and a decrease in the VIX. All of these factors work together. Many times crypto feels it before the stock market feels it. That's why it's vital to keep your eyes on the structural levels inside the crypto market. The timing cheat sheet plus the structural levels across the Tier 1, Tier 2 and Tier 3 charts mean that you will gain mastery over the markets. You'll become an institution of one. We've covered an absolute treasure trove of information in this video. Now you know what structural areas reside underneath these particular projections from the Wall Street analysts. You know that if the market comes down, it will pull down crypto and will pull down the alts. The alts will bleed much more than Bitcoin will. There's a lot of positive news in terms of ETFs getting approved. That could mean that Bitcoin could rally, but just be aware, if the yields go up and the DXY goes up, because you understand what timing means, this means that the S&P 500 and all the institutional players will divest of their holdings. That means the markets will come down. It's very important to keep your eye on your timing. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.